Hey everyone, welcome back to Corporate Decoder, the place where we, well, decode corporations. Today we are diving into the Federal Home Loan Bank of Topeka. Sounds boring. Just wait, because buried in this report are hints about how this bank is betting on the future of housing and the economy, and whether those bets are going to pay off or blow up in their face. Get ready, it's more interesting than it sounds. This report is basically a snapshot of the bank's recent financial moves, specifically focusing on the debt they are taking on. We are going to look at what kind of debt, how much, and what it all means for the housing market and the broader economy. This isn't just about numbers, it's about understanding the risks and opportunities facing one of the key players in the mortgage world. First off, this is a Form 8K filing, which is like an urgent update a company sends to the Securities and Exchange Commission, or SEC, about big changes that could matter to investors. It's not a regular quarterly report, so something must have happened that they needed to tell everyone about right away. In this case, it's all about new debt. The key date here is March 5, 2025. That's when the events we're talking about happened. This report is a snapshot of what was going on with the bank's finances around that time. So, who is the Federal Home Loan Bank of Topeka? They're part of a system of banks created by the government to support housing. Think of them as a bank for banks, providing funding to smaller banks and credit unions so they can lend money to people to buy homes. They are a federally chartered corporation, meaning they were created by the government and they operate across several states. They aren't exactly a household name, but they play a huge role in the housing market. Now let's get to the heart of the matter, the debt. This section of the report is about something called a direct financial obligation, which is fancy talk for saying the bank is borrowing money. They do this by selling bonds and discount notes, basically IOUs, to investors. These are called consolidated obligations and are shared by all the federal home loan banks. It means that if one bank can't pay, the others have to chip in. Think of it like a group of friends who co-sign each other's loans. It's important to note that these debts are backed by the financial strength of the 11 federal home loan banks, not by the United States government. That means if things go really bad, the banks themselves are on the hook, not the taxpayers, at least not directly. Schedule A is where things get specific. It lists all the new bonds and notes the bank is planning to issue. These aren't just small amounts, we're talking potentially hundreds of millions of dollars. It's like looking at the bank's shopping list for cash. The report itself even says that issuing these consolidated obligations is important or material to the bank. But they also caution that they aren't judging if any particular bond is material. In other words, they are saying we issue a lot of debt, but don't freak out about any one of these. Here's where we see the specific bonds and notes the bank is issuing. Let's dig into a few of these to see what they mean. Okay, the first entry has a trade date of March 5, 2025, which matches the date of the report. The CUSIP number is like a serial number for the bond, and the settlement date is when the money changes hands. The maturity date in October 2025 tells us when the bank has to pay back the money. This one is a non-callable bond, which means the bank can't pay it off early. The rate type is variable single index floater. That means the interest rate on this bond will change depending on some market index, like the prime rate. In this case, it's $250 million. The next one has a maturity date further out in March 2027. This one is callable, meaning the bank can choose to pay it off early if they want. It's also a fixed rate bond with a coupon of 4.45%, so the interest rate won't change. They are issuing $7 million worth. Here is one with a maturity date in April 2026, so a little over a year. The bank can choose to pay it off early if they want. It's also a fixed rate bond with a coupon of 4.39% and a whopping $250 million being issued. Here is one issued the day after on March 6 with a maturity in September of 2026 for $15 million at 4.3% rate. And finally, another issued on March 7th, maturing in March of 2026 with $2 million issued. Optional principal redemption bonds, also known as callable bonds, give the Federal Home Loan Bank of Topeka the flexibility to redeem them before their maturity date. This is beneficial if interest rates fall, allowing the bank to refinance at a lower rate. A Bermudan call style provides the bank with recurring opportunities to redeem the bonds on specified dates after the first redemption date and until maturity. This allows for strategic redemption decisions based on market conditions. Variable bonds offer interest rates that may fluctuate over the bond's life, adjusting to prevailing market rates. This type of bond can be advantageous in a rising interest rate environment. Fixed constant bonds maintain a steady interest rate throughout their term. These bonds offer stability and predictability, making them attractive when interest rates are expected to remain stable. The report is signed by Brad Gentry, FVP, Director of Funding, Hedging, and Member Product Pricing. His signature confirms that the information in the report is accurate to the best of his knowledge. So what does all this mean? The Federal Home Loan Bank of Topeka is taking on a lot of debt. They are betting that they can lend that money out to other banks and credit unions at a higher interest rate than they are paying on the bonds. If they are right, they make a profit. If they are wrong, they could lose money. The types of bonds they are issuing tell us something about their expectations for the future. They are issuing both fixed-rate and variable-rate bonds, which suggests they are not sure where interest rates are headed. The callable bonds give them flexibility to refinance if rates fall, but also come with the risk that they will have to pay a higher rate if rates rise. The amount of debt they are taking on is a bit concerning. It suggests they are either very confident in their ability to make profitable loans, or they are under pressure to increase their lending activity. Either way, it's something to keep an eye on. Overall, the Federal Home Loan Bank of Topeka appears to be in a decent position. They are well regulated and have access to a lot of capital. However, they are also taking on a lot of risk. Their success will depend on their ability to manage that risk and make smart lending decisions. The housing market can be volatile, so it's not easy. If there is a recession or a big drop in housing prices, they could be in trouble. Thanks for watching. If you found this corporate decoder video helpful, please like, comment, and subscribe for more deep dives into the world of corporate finance. What company would you like us to decode next? Let us know in the comments.